So my name is Saj Ashraf. I'm joined by my colleague, Lynette Moore. We're financial advisors with a company called Irish Pensions and Finance. Combined, we've almost 10 years worth of experience dealing with people like yourselves. We meet with people like yourselves on a daily basis in the public sector, and put plans in place for people like yourself. Now, a lot of you guys would kind of know of us or Irish Pension Finance as the AVC people. We have the AVC scheme set up through your payroll. We're an independent Irish-owned company based out in Cluny, County Meath, and we have a team of designated financial advisors who are all experts in the public sector. Now, this part is quite important that they're experts in the public sector because what it does is allows us to give basically relevant advice and correct advice for you guys on the call today. Now, we're very proud of over 28,000 clients. I think it's now gone up over close to 30,000 clients on our books, and we manage over €1 billion under management. So it just kind of goes to show you that people trust us with their finances. Now, obviously, we're going to say we're great, but you can pop onto our socials. So we're on Trustpilot, we're on LinkedIn, and we're also on Facebook and so on. So do give us a follow, and you can kind of see what other people have to say about us. Okay, so what we're going to do is we're going to jump into the content of today's kind of meeting and the objectives for today. So what we're going to try and find out today is what main scheme benefits are going to be available to you guys. So that's at retirement and also along the way while you're still kind of working. We're going to look at AVCs. What are they? Could they benefit you? They're not for everyone, but in cases where they do make sense, it can really make a financial plan make sense and it kind of allow you to do the things that you would like to do kind of in retirement. And lastly, we're also going to talk about the benefits of financial planning. Personally, I haven't really met anyone that hasn't benefited, from a financial planning review. The worst thing that can happen is you find out exactly what you're going to be on track for, get an insight into your benefits. Are you set for retirement? Are you set along the way? And are you protected along the way as well? So now, before we kind of jump into it, what I am going to say for everyone is the contents of today are going to be quite general information, but there is a QR code on all of the slides, I believe, Lynette, on going
Yes.
forward.
Yeah.
So I know it's lunchtime, so some of you guys may have to log off early. So if you are going to do that, so if you scan that QR code with your phone, it'll bring you into a page which will allow you to basically put your name forward for a 5-minute screening call. So I would encourage everybody on the meeting today, or everybody that put their name forward, to engage in the 5-minute screening call, because that's where we're going to go under the bonnet stuff. We're going to ask, personal questions, look at your own circumstances, and, if you're looking for numbers and so on, we can give them over the phone as well. So yeah, if you want to fast track it, do scan the QR code along the way. So, like I said earlier, a lot of you guys would have kind of know of us through the AVC scheme that we have set up, and the general kind of idea in the public sector is, if I have benefits through work, why would I sit down with a financial advisor? Okay. Now, for some cases, that is correct. You might be on track for where you want to be, and you may not want to do anything else. That's absolutely fine. But I guess some of the key reasons why people come to us on a daily basis is shortfall. So number one is shortfall in their main scheme benefits. What does shortfall mean? So 40 years in the public sector is full service. So essentially, you don't have your full 40 years done, or you're not going to have your full 40 years done come to retirement. And that could be due to a number of different reasons, joining late in the public sector, time spent working abroad, job sharing, reduced hours, career breaks, and non-pensionable employment. Just to kind of give you a brief insight into what that actually means. So if you join in the public sector late, that could be due to, you might have been working part-time, before you joined the public sector. In a lot of cases, people would have paid into a pension in the private sector, but they don't really know how it ties into their kind of public sector benefits. So if you're in that kind of scenario, do touch base with us and we can have a look at how it impacts your public sector benefits and what options you have available. Yeah, I guess the time spent working abroad, we do see that quite a lot now. People don't really kind of stay in the one place. For example, you might have worked in the UK, Australia, Canada, and the US, for example, and you might have come back and started in the public sector a little bit later. So meaning you're not going to get to your full 40 years. So yeah, if you fall into that category, do definitely kind of touch base with us and we'll sit down and have a look at that. Job sharing and reduced hours, I can definitely give you an example on that. So for example, I have a client who's a physio, actually, met with him recently. He's been working 30 years, almost 30 years in the public sector, but the first 10 years of his career was full time. Decided to have a family, dropped hours to half time. So for 20 years, he's been half time. So though he's been going into work for 30 years of his life, he only has 20 years reckonable service. Okay, so he's not going to have his full 40 years done come retirement age. So why is shortfall kind of an issue? The issue with shortfall is that when you get to retirement age, if you don't have your full 40 years done, you're not going to get your full pension. And that may be an issue in terms of, the retirement that you want, the outgoings, and so on. Non-pensionable employment, it could be private work. So if you have farming income, for example, or if you're just doing a few bits and bobs on the side from the public sector, a lot of times they're non-pensionable, meaning you're not paying into a pension, for example, but you are paying your taxes. But we can definitely show you a way to kind of make that pensionable. Okay, so they're kind of the reasons why you may have shortfall in your service, which means you want to kind of sit down and have a look at those, establish those, and then put the relevant plan in place to counteract those. Another big one we always see is the option to retire early. Basically, what that means is you don't want to work your full contract. For example, a lot of the newer contracts are, working till say 866 or 865. If you want to retire a bit earlier, you definitely want to sit down with us and see what are going to be the implications of retiring early, because there are penalties in the public sector for retiring early. So you may not have your full service, but also there could be a penalty that may be applied on top of that as well. Okay, that kind of ties into the next kind of point there is the pension age gap between the state pension and your own pension. So if you retire at the age of 60, for example, and your state pension, for example, at the minute is age 66, there's a gap of 6 years. What happens within that gap? Because you're going to be on a quite a reduced income, and that can be an issue for a lot of people. And I guess ultimately what ends up happening is for people that may not have a sufficient plan in place, they may be forced to work on, till that state pension age, which is currently at the age of 66. Now, the next one is pretty significant. Post 2013 single pension scheme members. The reason why we put that up is that's when the scheme changed altogether. Okay, and it became career average, as opposed to your counterparts, for example, who might have been doing the same job for the same amount of years. The numbers are very different. Okay, so if you're on that scheme, you absolutely want to sit down and speak to us, because the calculations are different in terms of how your pension is calculated, your lump sum is different, and so forth. Now, we do have examples, which we're going to run into in a few more slides, sorry, and then that'll kind of give you an idea why we're kind of saying you definitely want to sit down with us if you're post 2013. Now, they are all kind of your pension and retirement kind of options. You're going to have a shortfall. Might want to sit down with a financial advisor and have a look at those. But some of you on the call may not want to look at pensions because you might be either too far away or you might be set for pensions. But you might want to make sure along the way you're protected. For example, you might have got recently married, might have had a family, young family, or if you're buying a home or moving a house. So you might want advice on that. So we also look after all of that as well. So it's not just AVCs and pensions. We're financial planners, so we can have a look at those and kind of address those issues if they are a concern for you. Lastly, if you're concerned about the effects of inflation, I guess it's a bit of a hot topic. At the minute, everybody knows the cost of goods is going up and up and up, and there is, I believe, there's about 165 billion in it, if I'm not mistaken, sitting on the
On
Irish deposit
deposit,
market
yeah.
at the minute.
There is, yeah, between
That's
say credit unions and banks, that's just money sitting there dead in the water doing nothing.
Absolutely. So it's a real issue for the country. So a lot of people are saving, they're paying the taxes, they're hardworking, and essentially the money's now sitting in the bank or credit union, and then it's being hit with inflation. So if you're in that scenario where you have a bit of money sitting there, we can absolutely show you ways of offsetting the impacts of inflation, and make the money work a little bit harder for you. So those are kind of the reasons why not some of the reasons why public sector staff would sit down with us on a daily basis. Now, what we're going to do is we're going to jump into your superannuation scheme. What is superannuation scheme? So that's essentially on your payslip on the right hand side. So a lot of you guys would pay into it for years and years and years, may or may not know what benefits you actually get. Okay, so there are 5 benefits that you guys receive as part of your superannuation scheme. 2 of those are for your retirement, so that's your pension and your lump sum, and the other 3 are protection pieces for yourself and your loved ones along the way, basically. So number 1, pension, which is the most important one, that's your retirement income. So your replacement income in retirement, and it has to last you for the whole length of retirement. So it has to be sufficient. It has to do what it needs to do in terms of allowing you to do things that are important to you, for example. So during our financial planning consultation, what we're going to essentially do is we're going to stress test all of those benefits. You know, what pension you're going to be on track for, is it sufficient? You know, would you like to have a bit more, and so forth. The next thing is your lump sum. One of the great things, I guess, you know, retiring from the public sector is you get a one-off tax-free lump sum. Okay. Contrary to the belief, people think they get it once a year. You don't. Unfortunately, it is a one-off. But you know, it does go a long way. And again, if there's any shortfalls in terms of, you know, you may not have your full 40 years, which means you may not receive the full lump sum, we can definitely show you a way how you can kind of maximize that as well. Okay. The next one is your illness benefit, which I believe it's a great benefit to have. Now, a lot of people who work in the private sector have none of these really, to be honest. So the illness benefit is, God forbid, if you're to fall ill on a temporary basis, a long term, what happens? So you guys would have 3 months full pay and 3 months half pay from your employer on a 4-year rolling period. Okay. So during the financial planning consultation, what we'll essentially do is we'll stress test that. So for example, if you have a mortgage, there's 20 years remaining in the mortgage. If you're still out of work sick after the 6-month cushion, what happens? You know, where does the food come from? How's the bill paid? So we're not going into arrears and so forth. Um, the next one is your death in service. So that's your life cover element. God forbid if you're to pass away while employed, that's the sum of money that's passed down to your loved one. So it's either one time your income up to double your salary, you know, given down to your loved ones. The next one is your spouses and children's benefit. So that's God forbid if anything happens to you. There is a portion of your pension. In a lot of the cases, half your pension is left to your spouse, and a third of the other half goes to a maximum of 3 kids. Okay, so that's 3 children up to the age 18 or age 21 if they're in third level education. Okay, so those are the 5 benefits that you guys are currently paying into and that you receive. They're great benefits. I guess the whole point of the financial planning consultation or review is to kind of stress test them to make sure that they are enough um, along the way and on the other side in retirement. So again, what we're going to do now is we're going to just give you guys a live kind of working example of the pension that we talked about. That's the first benefit. So this example basically is for a public sector client earning 50,000 euro at retirement. So that's the salary, 50,000 euro at retirement, and they have their full service. So full service again, 40 years. Okay. So 50,000, you go on to retirement day the next day. The first column there, the green one, is for anybody that joined before April 1995, 6th of April 1995. Okay, so as you guys would know, that's considered the Rolls Royce of the scheme. So it's the best scheme out there. So if you end up on 40 years of service, 50,000 income, you get half your salary given to you as a pension. So that's 25,000 euro. Okay. Now, after the 6th of April 1995, the schemes became integrated. Okay, so what does that mean? So integration element is essentially a portion of your income is now paid by your employer, and the other portion is paid by the state. So that's the state pension. Like we said earlier, that's not paid until the age of 66. Okay, as opposed to previously on the green one, all of the pension was paid by the employer. Okay, why that can be an issue is, you know, you might retire at the age of 60 because a lot of the contracts will still allow you to retire at the age of 60 or even 65. There's a gap of either 6 years or a year where you're getting a portion of your income, which again, for the same example, will be 11,205 euro. Okay. The next one is essentially the post 2013. This is when the schemes became different altogether, so the calculations are different. What they've done essentially is they've added an element of career averaging to your scheme. So working the same job, same income, with the same years of service, you're ending up on 7,500 euro per annum as income. Okay, so you can kind of see there's a clear kind of decline in terms of the schemes as they've gone on. The calculations haven't gotten better, they've gotten worse. But I guess that's really why it's important to kind of know these as early on as possible in your career so you know what you're on track for and kind of have a relevant plan in place if it makes sense to do so to kind of counteract those. Okay. So I guess the next example is same example, you know, public sector client on 50,000 euro with full service, but this is for your lump sum. Okay. So if you are on the schemes that joined before 2013, so anybody that joined up to 2013, January, you will essentially receive 1.5 times your income as a lump sum. So that's 75,000 euro. Okay. Half of that will be 37,500. Okay. So that's 20 years of service. Remember I said earlier, even though you might be working 40 years, but you might have worked half time, so you don't have the full service. So you get it pro rata, essentially. The orange column there is post January 2013. So same example, you're on a 50,000 euro worth of an income. You've done your 40 years, same as your colleague on the previous scheme, but your lump sum is roughly 60,000 euro. Okay, as opposed to the 75 earlier, and half of that would then be 30,000 euro. So that's essentially your income and your lump sum that you guys would receive. Again, that's kind of an example of 50,000 euro. So I guess looking at those, a lot of people, I guess the main questions that we get asked is, how much should I have in retirement? So we don't really like telling people how much they should have because everyone's different in terms of what they want out of retirement, what they want to do in retirement, travel, play golf, all that kind of stuff. Some people may still have a mortgage in retirement or might have kids in college. I guess this particular slide is really, really good in terms of kind of giving you guys an idea of an average outgoing in retirement. And by the way, this is done by the Central Statistics Office, so we haven't come up with these numbers in any way. So if you have a read through kind of the things that are average in retirement, now obviously everyone's going to be different in terms of if you look at like entertainment, that includes your socializing, hobbies, travel, and so on. It's 4,798 euro. Some people might look at that and go, absolutely, how are they doing that? I spend that in 6 months. So the average outgoing at the minute is 35,000. That's what you would need in retirement. Now, a good point to make on this is net. So what net means is this is after tax. So all pension is taxable in retirement as well. So this is earning an income, paying your taxes, and taking home 35,000 euros a year will allow you to do those things on an average basis. Okay, and just underneath that, if you see this is in today's money, the reason why that's important is inflation, as you spoke about earlier. The cost of goods, basket of goods is only going up and up and up. And if you're not retiring for another, let's say 10, 20 years, 35,000 euro isn't going to buy you the same things at that stage. So I guess to that question, how much I should have, it's really entirely up to the individual. And that's really what we look at during our 5-minute screening call, is to kind of give you what you're on track for and then understand what your goals are and kind of put a relevant plan in place to allow that to happen. Okay, so what I'm going to do is I'm going to pass you on to my colleague Lynette. She's going to just essentially walk you through the AVCs and how we go about boosting those benefits that we've just spoke about.
Perfect. Thank you so much. So really, I suppose to kind of work off of that then, if we kind of look at the previous slide, again, as Saj explained, this is the cost for a household at the minute if they've retired. So 35,000 a year net, as Saj explained. This is the average outgoings based on the CSO. So if you were to fall into one of the examples here, maybe you aren't on the original pension contract, the Rolls Royce, as Saj explained earlier. Maybe you're on one of the newer contracts and you could be looking at these projections going, well, if I'm only on 11, 12,000 a year or 7, 8,000 a year, I want to retire before 66 and I'm definitely going to have similar outgoings. How do I make up that difference? That's the huge kind of burning question. And essentially for most people that are kind of logging on today, AVCs will probably be some of the most flexible and suitable and efficient way to actually boost up your income and your financial security in retirement. Now, some people here may be in a very different situation. That's why I said this is going to be very, very generic, but some of the other, I suppose, ways that people fund their retirement might be they might have rental properties, they could have farming income, their spouse might have the bigger pension, or you don't know, they could be a secret millionaire in the background. You never know, I suppose, until you look under the bonnet. But for the rest of us that don't have kind of all these other assets and incomes kind of up our sleeve, this is going to be the absolute best thing to take advantage of. Now, what I suppose AVCs are, you've probably heard of them online, colleagues talking about them. You know that this is something that you can have up and running through your payroll, but it's an additional voluntary contribution. And I think voluntary is a really, really huge word that I like to focus on. Voluntary means you're choosing to do this on top of your main scheme, on top of your pension contract. So it's very, very flexible. And I'll explain the flexibility on the next slide. But really, the biggest enticement with AVCs are whatever you save into an AVC, you get tax relief given to you by the government to help your savings grow further. So anyone here that maybe remembers the SSIAs, the government saving bonds back in the early 2000s, whatever you saved in, the government gave you 20% to add on top of your savings. You did that for 5 years and you got a nice chunk of money at the end of it. The AVCs are almost kind of modeled similar after that, but it's based on what type of taxpayer you are. So the example I have up on the screen here is if you're a higher taxpayer. So if you're earning more than 44,000 in a given year, if you were saving 150 euros, and if you save that in the credit union or the bank, we know we're not getting any interest from the bank to help us. We're not getting any relief. And any interest that we are earning is being cut down by a third by dirt. So the deposit interest retention tax that we have to pay in banks and credit unions. But if we took the same 150 euro and we put that into an AVC instead, the tax man will give you 100 euros relief to add on top of your savings. So essentially, you're close to almost doubling your savings, but you haven't had to do any of the extra heavy lifting yourself. You've used your tax relief to your advantage to make your savings easier and more efficient. And it means as well in the long run, some of you might have the same opinions as me, but it means that you're not paying as much tax to the taxman at the end of the day. You're squirreling that money away into essentially like an AVC account that has your name on it. And whenever the age is that you choose to retire is when you get to crack open the account then. So to kind of dive into a little bit more about how they work and some of the kind of main questions that we get around it. So as again, most people in here may or may not know, the public and civil sector. So if you're in, Department of Justice, HSE, the county councils, you're working for revenue, whichever I suppose kind of sector that you're working in, we offer the ABC scheme to be set up through your payroll. So that means that it's done at source, works very, very similar if any of you do, say, the credit union savings clubs or the Christmas savings clubs. And it means that all your tax relief is done on your behalf. So you don't need to go to revenue at the end of the year. You don't need to claim this. Once it's up and running, it is all done for you. It's nice and lazy, inconvenient. Now, because as I said earlier, these are voluntary, they're flexible. So you can increase and decrease how much you save into this on, say, on a year-on-year basis. And where I suppose this is really important, where you might be looking at this and you're a lot further away from retirement. Maybe you're earlier on in your career, but you might have things like young children. You could have childcare costs. You could have a big mortgage. You could have a car loan. Your affordability is going to be different, and you need to obviously be able to cover your outgoings now while also being able to save for the future for yourself. So you're able to start at lower AVCs and then you can increase them in line with, I suppose, changes to your affordability. Or maybe I have a lot of cases like this that happens, and Saj would probably agree with me on this. You could have a pay increase coming up in your salary. You could be going on to panel. You might have a loan finishing, or a huge one if you're coming close to retirement is your mortgage finishing, or your kids coming out of education, because that basically is like a second mortgage these days. But if you have any of these big kind of changes happening for the positive financially in the background for you, it's a great way, I suppose, to take advantage of already being used to paying towards something and using that money as a way to set up an ABC for yourself because you already have the affordability, you're used to paying it. And this way, at least, instead of paying off debt, you're building up a nice bit of wealth for yourself instead. Now, the ABCs, as I said, you can increase and decrease throughout the time. You can stop them and restart them. So again, another idea is, let's say again, you're earlier on in your career. Let's say you're a woman, you want to have a baby and you're going to be going on, say, maternity leave and unpaid maternity leave. You can pay into the AVCs when you're getting paid, and then you can stop the AVCs obviously when you're on unpaid work. So again, you're not locked into this. It's not like a mortgage, or it's not like buying years of service where you have to meet the X amount cost every 2 weeks. Very, very flexible. The AVCs look in order to protect against the long-term problem that is inflation and everything getting more and more expensive and our money getting less and less powerful. The AVC is a form of investment. It has to be invested in order to keep up with the cost of everything. Now, we will always go through what fund and what investment is going to be most suitable to you, because it all comes down to how close or how far you are to retirement, what you're doing the AVC for. So it's very, very personalized that way. But I do just want people to get comfortable with the idea of we no longer can just leave our money in the bank long term. We have to do things like investing, and an AVC is a way that you can take advantage of the very, very advantageous tax relief, which is guaranteed. It's just based on what type of taxpayer you are, as well as earning a bit of interest on top of that. Now, the question I suppose that is on a lot of people's minds, and I'm seeing this online, I'm getting emails about it, there's podcasts and everything about it, is in relation to charges when it comes to ABCs and pensions. So, and there's a lot of confusion about it as well, and I don't blame anyone for being confused, because different pensions and different providers have different charges. It's all about finding what is most suitable to you and your needs and your situation going forward. Next time, I suppose, if any of you are looking at your payslip, take a look under your deductions, because a lot of people are under the impression that when you're in the public or civil sector, you don't pay for your pension. You do. Under your deductions, it says additional superannuation charge, or ASC. A lot of people think it's a typo and it's meant to be USC. That is technically a charge or a deduction or like an annual fee for having a pension facility, like having a pension through work. So the exact same is true if you're doing an AVC or a private pension. There are going to be charges incorporated for it. Now, the way that we do it is we do not charge set consultation fees. So if you want to meet with your advisor 6 times a year, and I have plenty of people that do because they have a lot going on, they're not forking out of their own pocket to pay for a consultation every single time. So it means you can get the advice when you need it, and you don't have to pick and choose which is more important, or try and fit it into all one consultation, and your ears are bleeding by the end of it. Where I suppose this would differ is like if you were going into, say, your branch and you were speaking with the financial advisor in a bank or with other brokerages that are out there, you are paying out-of-pocket consultation fees. Now, how we can have this set up an agreement with the public sector that we don't do consultation fees is the set of charges and the consultation fees are built into the plan. So the simplest way to explain this, and again, it is tailored to the individual and how far or close they are from retirement in terms of how much or how little their charges are. But in the first year of having your AVC set up and running, instead of getting all of that tax relief going towards your AVC, you're using some of that tax relief to cover the setup costs of the policy, of your payroll deduction facility, your policy fees, and all of your consultations. So we're all about, I suppose, look, using your tax relief in the first year to pay for the service, you get it out of the way. And then from your second year onwards of having the plan in place, the majority of your tax relief is going into your plan and you're building up the funds in the background for yourself. That's the allocation rate, or the allocation charge. Very, very hot topic. And the second charge then is the fund management charge, sometimes also called the annual management charge. Essentially, we would have the cheapest annual management charge on the market out there, because this is done as a group scheme. This is the union sponsored scheme that they set up for staff 30 years ago. And what the cost of this is 0.75% per year. So it's 0.75%. And this comes out of the total, I suppose, kind of amount that's in your ABC account. And this is going to the people in the background in New Ireland, because that's who facilitate this ABC scheme, that are managing your money on a day-to-day basis. So if we think of it this way, if they're getting paid off of how well your money is doing, they're going to work harder to make your money grow faster and bigger. So we want to have some type of charge in there to make sure that they're still working, but we don't feel that it's necessary to overcharge on that, because we want people to be really involved as early as possible with their plans and their saving for retirement. And that means you have the potential to build up really, really big, significant pots of money. I'm talking over 100, 200,000 euros by the time you get to retirement, if you engage in this kind of, 10, 15 years out. And we don't want people to unnecessarily be paying more charges in the latter half when their funds are the biggest. So that's why we charge, I suppose, the lower fund management charge, the lower annual charge. The standard fee kind of out there in the market is 1%. So what we always tend to find is, look, In year one, we do say maybe lower allocation, so we don't do the consultation fees and we do the lower annual charge. Other providers out there might not do the lower allocation. They give you a better allocation in year one, but they're going to charge you more every year going forwards instead. But as I said, there's quite literally something there for everyone. And the more information you have, the better informed decisions you're going to be able to make for you and your financial planning. Out, I suppose, all your finances. A lot of people do want to start with the pension because, again, it's a very hot topic. There's a lot of changes legislation-wise, not only with the state pension and maybe, in the household, there could be someone in the private sector that doesn't have a pension, whatever I suppose the reason is. But we essentially want to make sure that you're given the correct advice. It's all, I suppose, in line with your what contract you are with the public sector. There's not a lot of financial brokers or advisors out there that have the comprehension of the public sector the way that we do, because as you can imagine, it's very, when it comes to pensions in Ireland, it's very, very complicated. It's nothing is straightforward when it comes to it. So we at least want to be able to break it down for you in a very, very simple way, help you determine, are you happy with your pension and lump sum? Are you not? Are you happy with your protection needs as a family? Are you not? And to step in and I suppose work with you, your family, and your affordability to get you on the right path towards your goals. Um, those, I suppose, would kind of be the main reasons, the initial reasons, kind of why people want to meet with us. Now, I've probably harped on enough about pension and retirement, and there could be other people here that, again, it's not at the forefront of their concerns. But as Saj kind of mentioned earlier on, inflation is a huge topic of concern and contention. If we were to go back even say about 12, 15 years, if we saved in the bank or the credit union, they were offering interest rates of about 5%, and inflation was much lower than that. So we have such a habit, I suppose, even I remember when I got my communion and my confirmation money, it went into the credit union because that was the good habit that our parents instilled in us. And we still have that instilled with us now. The problem is these facilities like credit unions and banks and even Unpost are not keeping up with what's happening out there in the real world. So what I suppose is the alternative. So as I said, I've gone on and on about the AVCs, but I really, I suppose, kind of want to show you that the power of choosing where you save your money and for how long has such a massive impact on your financial security as a whole. So I suppose logically speaking, the earlier on that you get involved with choosing where to save and how much and for how long, the length of time you have to save into something, the better off your returns are going to be. So that's, I suppose, kind of what this bar chart, this chart is up in front of you. We've taken a couple of different examples of someone who's aged 30, 40, 50, and 60, and they're again saving into a bog standard investment. So when I say bog standard investment, it's just basically an account where you're earning on average about 5% a year in growth. So essentially what savings accounts used to be, but they're not offered anymore. So we have to go elsewhere with this. If you were saving 5,000 a year, now that breaks down to about a little over €100 a week. If you did that at the age of 30, by the time that you got to age 60, you'd have almost €480,000 saved in that pot of money for yourself. If you had never saved in something that was earning interest, so like an investment or like an ABC, for the same 30 years, if you saved in the credit union or the bank, you'd only have 150,000 saved. So I don't know about you, but if someone said, right, in 30 years' time, if you're saving €100 a week, would you rather have 150,000 or would you rather have 479,182? I think I know which one we're all picking at the end of the day. And even look, if you're older and you're not able to give it the full 30 years, the same goes even for, again, starting at 40, 50, or 60. Giving your money the opportunity to grow and give you returns is going to be how I suppose we take control of our finances back. We give ourselves financial security so you can choose how much you want to work. If you want to keep working, maybe you drop your hours down, maybe you retire early and you're looking after the grandkids, whatever I suppose your motivation is. But we're now moving into the stage that the financial security is now completely on our shoulders that we need to do. So I thought it was interesting just to see how, I suppose, the power of years and compounding. And honestly, if you were investing and earning 5% a year, that's a very, very average returning fund. If you were picking the right company, and this is essentially what the likes of myself and Saj would do with you in a one-on-one consultation or even on the screening call, is to talk you through what companies out there are the most suitable based on, again, how much you want to save and why you want to save. You might not want to save for the full 30 or 35 years. You might want to save for, say, education costs and your kids are young. And a lot of people, even, I think it's brilliant, they'll save the equivalent of their children's benefit. They'll put it into an account that's actually earning money. And then 18 years later, they get to crack that open and they've got all of their education and rent or to buy a car for the kids set aside. And they use the power, I suppose, of years and years of compounding interest and getting their money working for them to take what's usually a very financially stressful time of life, and they've planned basically for it. So to kind of move on from that, I suppose we've kind of harped on about and really explained what the financial planning process is as we go through this. So it's different for everyone. It's completely based on your individual needs. But essentially, what we'd always encourage people to do, as I said, is to, again, open up your phone, the camera, hover it over that QR code, provide as much detail, I suppose, you're comfortable with, and to have a quick 5-10 minute call with myself, Saj, or one of our other advisors in-house here to really, I suppose, maybe answer what your own concerns are, if you wanted to go through and take a look at what your employer benefits are, or if you have an idea of I'm saving X amount per month and I want to save for 6-7 years, what company should I be going with? What should I set up for myself? But that's essentially kind of what we want to help you get through. Something I suppose we didn't go through in too much detail because we wanted to leave it until the very end here is in terms of your protection needs. So Saj earlier on went through the 3 protection benefits that everyone here has as a public servant. You've got sick pay, you've got death in service, and you've got spouse and children's pension, or spouse previously called widows and orphans pension. For some of you, that actually might be perfect. You might not need a lot more protection other than what your employer gives you. You could have something private in the background, or again, other assets we don't know. But where I suppose we see people that maybe need to take a bit of a closer look for their protection is going to be the likes of if you're younger, if you've got a young family, if maybe you've got the bigger income for the household and the likes of you have a mortgage in place or bigger loans and debts. So again, if you've got childcare costs, we all know that's essentially another mortgage that's going out. If something were to happen to you or your partner, whoever I suppose especially is the bigger earner for the household, we have basically curtailed a kind of 3-in-1 protection plan for the public service. This is, I suppose, to go as a bit of a competitor to, I know through Corn Market, they have life cover and sick pay through this. I think it's 2 separate premiums or 2 separate payments that you have through work. But essentially, this is to bundle 3 policies in one. So what the bundle is you can protect your income. So if you're off for longer than 6 months, let's say you were in an accident, you were paralyzed, or you were off on stress leave, or again, you had, heart condition, cancer, whatever it is, but something preventing you from going back to work after, I suppose, your sick pay for 6 months is done up with, you can take a policy out to ensure your income to make sure that financially you're not stressing, you're not rushing back to work before you're healthy and ready to do so, and the house is still ticking by in the background. Included in that, you can also have €40,000 of life cover. So you will have anywhere from 1 to 2 times your salary paid out as death and service. But this is just to make sure you have an additional 40,000 to cover, look, any initial costs if you're to pass away prematurely. Mainly, actually, a lot of the time, it's to cover funeral expenses or additional childcare costs or to cover off a couple of debts. So the surviving spouse or the family aren't kind of left financially bereft as well as emotionally. And as well as that, also including serious illness cover of 40,000. So this is to protect you, your family if you pass away, to protect you if you're off long term and replace your income. But if you were diagnosed with something like cancer or have a heart attack or a stroke, typically when we have those, because obviously health care has gotten better these days, you're usually kind of back up on your feet and back to work in less than 6 months. So it's just to make sure that in every case of you not being able to work or passing away, there is something there to support you and your family financially. We have it all bundled. It's all been offered through Aviva. And the good thing with this means it's only one premium. The premium does also include tax relief help because when you take out income protection, the government help you cover some of that cost. So we've been able to bundle all this together to streamline it also. So if you don't know how much cover you need and you do feel that maybe you're lacking in protection, I strongly recommend this because it is such a comprehensive amount of cover. So what I'm going to leave you on with is just very, very finally, and then I'll keep the QR code up just at the end for a couple of minutes. For those of you who, again, if you've got questions specifically around mortgages, I'm aware that there's announcement that another bank is leaving. So there's more banks leaving than there are coming into Ireland that are offering mortgages. So again, it can get a little bit overwhelming at the thought of Jesus, where is my mortgage going to be? What options do I have? But essentially what we'd be able to do is if you're a first time buyer, if you're a second time buyer, and if you're looking to switch, if you're looking to see can you get maybe your interest rate down, if you want to maybe reduce your term, that's a huge reason as to why people want to switch their mortgages to try and get the best rates and the best terms out there. But also for the instance, if you need to maybe do some future proofing on the house. So if you want to release a bit of equity in the house, maybe to get the energy rating up, obviously you need to put some money into the house in order to future proof it. If you've got a bit of equity in the house, again, we'd be able to link you up with our in-house mortgage broker. Take a look at your situation, what you're looking to do, and what are going to be the best options out there with what's left, I suppose, on the market. So by all means, when you're, I suppose, kind of filling in this QR code and you want to provide details, if you just want to speak about mortgages, if you pop that in along with your name and your number, we'll get you in contact with our in-house mortgage broker. As I said, absolute expert, and we have access to kind of all the different lenders out there. If, as I said, you just want to get an idea of your figures for your pension and lump sum, you can pop that in on the questionnaire as well. Or if you're not really sure where you want to start, but you know you need to do something, again, absolutely fine. It's why we'll always say to people, go for the 5 minute kind of quick call afterwards. The more information you have, the better a decision you can make for yourself and your family going forwards. After that kind of 5 minute call, you might get all of your answers. You might not be in a position to start something, due to affordability, and that's absolutely fine. You know where we are, and you can come back to us when you are ready. But after the screening call, as I said, hopefully you'll have a much better idea as to whether or not you'd benefit from booking in for a full one-on-one consultation. We hold these consultations over Teams or Zoom. So what we can then do is take a really, really thorough look as to what's happening financially for you at the minute, individually or as a household. What do you have through work if you weren't to set up any kind of plans or policies going forward? Help you stress test to see, look, is that in line with your goals for what you want to see happen? If you won't have full service, if you want to retire early, or kind of any reason in between there. And then, as I said, look, we'll then take you through what are the options in the market and what would be the most suitable to get going for you in the meantime. So be that AVCs, be that a bit of extra protection for you, the family. Maybe it's just to get your savings working a bit harder, or you want to prepare for education costs for the kids. It's really going to be down to you. But I do want to thank you today for your attention. I know doing this through lunchtime sometimes can't be the most fun that you want to go through, but I hope everyone here got something out of it. So thank you so much for your attention. I'll leave this up again on the screen there for the next minute or two, just for you to get a chance to get your phone out, open up the camera, hold it up over the QR code. It'll take you to a screen just to fill in your details, and hopefully in the next kind of day or two, either myself, Saj, or one of the other advisors will be able to get through to you. I do think I have a
Mhm.
couple of questions here
Yeah, I was just
on
going
the
to say
queue.
actually,
Yeah, sure,
there's a
perfect.
few
So
questions. I can actually call them out to you if you want to
yeah,
go
that'd be
through them.
great.
So we have a question here that's asking, this person came and left the health service
Yeah.
over their career with non-public service jobs in between.
Hmm.
Now they had contracts both pre and post 2013. Okay.
Yeah.
How will the final pension be calculated?
Oh, it's a really good question. So the easiest way I suppose I got my head around it initially was if you have a contract from before and after 2013, I want you to think of them almost like two completely separate jobs and completely separate contracts. So they will be calculated as per those contract rules separately. And then when you retire, they'll add them together and then pay you. So if you joined, let's say, in 2003 and you worked for 10 years, you'll have built up a pension and a lump sum, and you'll be entitled to claim those benefits from age 60 onwards. And let's say in the meantime, you joined back in 2020 and you work for another, say, 10, 15 years, and that's payable at 66. Just think of it as they're two completely separate jobs and employers. They're calculated separately and they're paid to you as per what your contract says. So 60, 65, or 66. Yeah, it's a great question. Thank you.
Great. And it just another one here says, what are the penalties for retiring early? Um, I guess I'll take that one. It's
Yeah,
essentially
sure.
dependent on how early you want to retire. I guess
Mm,
that's really what we look into. So, for example, during our 5 minute screening call, that's the kind of questions that we're going to go through. You know, what are your goals? When did you start in the public sector? When do you hope to retire? And so on. And if it is a case that you do want to retire a bit early, for example, let's say post 2013 staff who have to work till 66, but don't want to retire at 60, the penalty essentially is calculated based on the age you do retire and take your
yeah,
benefits. Okay.
yeah,
So the earlier you retire, the easy way without going into numbers is the earlier you retire, the bigger the penalty. So
yeah,
it gets bigger and bigger and bigger, basically.
yeah.
Now, even a year early, to be honest with you, in a lot of the cases, they're quite hefty, to be honest with you,
Mm,
especially if you're not working as late, meaning full contract, it already shows that you don't have probably full service. And if you're adding a
mm,
penalty on top of that, it can really kind of add to that
yeah.
negative aspect. So yeah, it really is dependent on when you want to retire and the penalty gets bigger and bigger. Um, let me see here. So it just says here the QR code opens the Department of Enterprise, Trade and Employment.
Remember,
Should it be for
the-
Department of Health? Sorry, sorry, yeah, if you
with
want to take that one.
I'll take that one. Yeah. So essentially, because this is open to everyone in the public sector, we weren't able to put this just for Department of Health and that. So if you can go under the Department of Enterprise one, just say you're at the lunchtime webinar, and we'll contact you regardless. So if you're Enterprise, Health, Justice, HSE, whatever it is, it's absolutely fine. So you can go ahead and use that link in the background as well.
Great,
Yeah.
great. So it just says here. Now we'll try, guys. By the way, just to let you know, we'll go through this as quickly as possible. Just conscious of time. I know you guys are lunchtime as well, but again, do take advantage of that 5 minute screening call.
Yeah.
That's really we're going to go through all the
Yeah.
questions. So, I joined a bit late. What is the name of your company? So, it's Irish Pensions and Finance,
Yeah.
by the way, or IPF. Um, yeah, the QR code is there, by the way, for the person asking that. If you basically hold your phone up with the camera app, it'll allow you to kind of go into a page where you basically just put in your name, contact number, and so on, which allows us to kind of contact you. Now, the people that are coming through the QR code, we are going to kind of prioritize them, I guess, because you've done that, you've taken the time to do it. But we will be touching base with everyone over the coming days.
Yeah.
The next one is, I'd say this will be probably the last one then. So it's,
Yeah.
does an employee who commenced in 1997
Yeah.
qualify for the supplementary pension between the ages of 60 retirement age and the OAP age, which is a state pension age?
Yeah. So again, really good question. We didn't go into too much in terms of the supplementary pension because it's so dependent on the person, your department, and when you joined. The very short answer is if you joined between the 6th of April 95 and the 6th of April 2004, you are meant to receive a supplementary pension. So if you retire at 60, you are meant to receive a supplementary pension from 60 until 66. The reason I'm saying meant is I do not know if that is in stone, if that will still be allowed, depending on the next number of budgets that we get. But the people who are retiring now, yes. So you would get your employer pension at 60 and you would get the supplementary, which is basically in the same kind of amount as the contributory state pension. Now, I will just say if you are doing any other type of private work, be it full-time or private, and you're getting a supplementary pension, the supplementary pension will be reduced. So just to be kind of cheeky, if you're doing it like that, cash in hand. You didn't hear that from me, but essentially just to be kind of wary of that. For the people who joined in terms of the supplementary pension, if you joined after 2004, essentially no, you won't get a supplementary pension because your normal retirement age is meant to be 65. So if you retired at 65, you get almost a year of job seekers allowance, which takes you almost supplements you until 66. So it's really only if you joined before the 6th of April 2004. And definitely for the guys who joined after 2013, there's not going to be a hope of you having anything like that, because your retirement age is linked to whatever the state pension age is. And I suppose their logic is, if you're choosing to retire earlier than what your contract states, we don't have to provide anything supplementary. So just for that 95 to 2004, your retirement age is pretty much from 60 onwards, which is why they've had to come in with this supplementary pension. But you would get more information on that from your employer, because it is your employer that would pay the that pension. It comes out of their budgets. That's why I'm saying meant, not 100%. I can't give you that answer, I'm afraid.
Yeah.
So look, I think we'll leave it at that, so everyone can maybe salvage and get a cup of tea or a coffee kind of at the end. But again, thank you so much for all the questions. I really love to see the interaction. If we didn't get to all of your questions, I'm very sorry, but as I said, just pop the question onto that QR code. Don't mind if it says enterprise on. As I said, it's just a bit of a catch-all to get everyone here, because it is for kind of everyone here from all across the country. But look, thank you so much. It was been an absolute pleasure this afternoon, and we look forward to speaking to you in the next couple of days.
Yeah. Have a good one every day.
See
Thanks.
you, everyone.
Bye bye.
Bye-bye.